Glad to know you're still with us. Nigeria's economy posted broadly positive results in the first half of 2025 with gains in inflation, exchange rate stability, PMI, GDP growth, and investment markets, according to Norrenberger. The firm projects real GDP growth of 4.05% for 2025, but warns that debt sustainability and oil price swings remain key risks. The report further stated that achieving Nigeria's $1 trillion GDP target by 2030 will require 22% annual nominal growth and an exchange rate of 1,200 naira per dollar. What are your thoughts? Let's get talking. Samuel Oyekanmi, Research and Insights Lead, Norrenberger Financial Group, joins me for more on this. Thank you so much for joining me, Mr. Oyekanmi.
Thank you very much for having me.
Right, let's dive right in. You posited in your report that the macro indices sort of, look good in H1 2025. However, irrespective of these figures, the figures you churned out, which of course correlate with what we have out there, food inflation and core inflation remain a drag on consumer wallets and spending. Even the exchange rate, though relatively stable, isn't yet at a place we would call the fair value. Shouldn't these be the most important markers of ease in this economy?
Yeah, they're quite important metrics, of course, when you look at it. Things that affect the average Nigerians the most, of course, inflation and then exchange rate, just as you said. But what we're doing in our report is we're doing the first half review, right? And then when you compare what you have at the end of June to what you had at the beginning of the year, this seems to be in better position compared to where we were. And that's why our report is saying that it's a great recalibration. We're moving from a point of shock to a point of calm. Inflation used to be over 34% at the beginning of the year. As a result of the rebasing, there was a technical decline to about 24%. But even in the last 3 months, we've seen moderations in inflation numbers, both from the food side of things and then from the core side of things, especially from the energy side of things. And it looked poised that that's going to continue, considering that we've also seen during the week, Dangote Refinery announced the reduction in terms of petrol prices. And then for food, there's always the impact of seasonality. So that also plays around there. Then look at exchange rates. It has been stable around 1,550-ish in the first half of the year. And it looks like that's where the market is pricing it. We're not saying that the average Nigerians are wealthy. We're saying that where we used to be, where we are now is better than where we used to be. And that is an indication of impact of either tapering effect of those inflationary policies from 2023 and 2024, or a combination of the fact that there's a base effect and then things are beginning to shape up away from those high shocks that we had before now.
Well, that's quite interesting, but not so much seems to have sort of changed so far, and the Monetary Authority has maintained its tightening stance. When I'm talking about when you look at the real economy right now, and then while its policy, that's the MPC's policy, seems to be yielding results, we know production, business growth have been the trade-off. Why isn't there a visible, handshake between the fiscal and monetary authorities to sort of strike the needed balance? Because when you look at some of the things we've talked about, some of the, changes we're seeing, the recalibration we're seeing, a good number of those you might say are from the monetary authority. And for the other ones, they're not necessarily we're not saying the transmission, which is very important. That's why I'm bringing us to this, conversation around the policies, how we can have a handshake to ensure that there is transmission. And while whatever it is the central bank is doing is yielding results, we're also saying something from the fiscal authority.
Yeah, spot on. There really needs to be a handshake between both fiscal and monetary policy. And that's why even somewhere in the report, we also mentioned the fact that there needs to be a handshake between the government and then the private sector in order to enable the holistic growth that we want to achieve. Of course, we have an ambitious plan to hit $1 trillion economy. That's not going to happen just by the monetary policy tightening interest. In fact, that is even counterproductive as a matter of fact. So there is a need for the fiscal side and the monetary side of things to align. And that's a function of a couple of things. So for one, the CBN needs to see interest rates needs to start still see inflation start tapering down more sustainably. Because, for example, if you look at June numbers, we saw headline inflation decline, but on a month-on-month basis, it rose its highest in about 3 months. And for the CBN, that's an indication that we still have inflationary risk. So they need to start seeing inflation really taper down consistently for them to change their monetary policy approach. But for inflation to taper down consistently, we also need the fiscal side to tackle some of the things that is also impacting inflation, one of which includes insecurity in food producing regions. So when you have fiscal authorities start tackling things around security, ease of doing business, of course, interestingly, with same PMI numbers improved in recent times. It's over 52 points in recent times, and that gives an indication that the manufacturing sector is also doing well from those terrible numbers that we had last year, around 49-ish. So that's important. But the federal government or the fiscal government really needs to do better, and beyond just the federal part of the government, it needs to be holistic at the federal, state, and local government levels. The government needs to have enabling policies that ensures private sector pretty much do business more effectively and efficiently. Because when you have those capitals really coming into these sectors, that way we can drive more business activities, you can have better employment or better increased employment, and that is also better for the economy. That way we can achieve even our projection of over 4% growth, and then the $1 trillion economy by 2030, then it's a possibility. But without this handshake, it becomes a tough call.
Interesting. I like the fact that you talked about capital, and that sort of takes me to one of the points you also highlighted in your report, talking about investment and how that it's taking shape. I totally understand the angle you're taking it from, but let's look at the dwindling FDI. I mean, in Q1, we saw a 70% decline from Q4 2024 figures. Now, over 90% of Q1 inflow is FPI. That doesn't look sustainable, knowing the attendant risk, of this composition, whether you want to talk about ballooning debt or whatever it is. Talk to us about this, really.
Yeah, of course. The fact that we have a huge chunk of our capital inflows in portfolio investment continues to be a worry. It's a trend, right? But I think when you look at those numbers again, you also want to be able to compartmentalize it and really dissect it. I would not compare Q1 numbers to Q4. I would compare that to Q1 because, of course, there's always a seasonal effect, even when it comes to capital importation. And then when you compare FDIs on a year-on-year basis with Q1 2024, 2023, you see that there's some level of improvement in there. Of course, FPI is really pretty much is a worry because the chances are the high interest rate environment has really given room for portfolio investors to come in. But of course, that could change anytime soon, and then you might now start seeing some of these investors repatriate their funds and easily move out of the economy. The FDIs are those ones that would ensure drive significant economic growth, create employment. We don't have that so much, but I would not say we are worsening. I think we are at a point that looks like things could really take shape. Like I said, I would compare Q1 to Q1 last year, and that's an improvement compared to a Q1, which shows a significant decline. But then again, FPI is still a worry. I think the government would really need to do a lot more to ensure that direct capital come into the economy, because that's what's going to drive economic growth. That is what can ensure that the government hits its target of the $1 trillion economy. That is what is going to take us away from the quoted unemployment rate of 4.3% that we currently have. And that's also going to ensure that the multidimensional poverty rates that have been quoted by the World Bank and even the MBS, and the number of poor Nigerians that we have actually are taken away from that bracket. The amount of jobs that can be created with increasing FDI is something that I think the federal government and across all government levels really need to start taking a hold of and start creating policies around ensuring those kind of fundings and capital come into the economy.
All right, that's quite interesting. I like what you said about the fact that we should do Q1 to Q1 and not Q1 to Q4. Talking about that, beg your pardon, in Q4 2024, when you look at the composition of capital inflows, we see that FDI in Q1 2024 was 3.53%. I don't know if we can have that slide up that compares Q1 2024 with Q1 2025. You have that. Meanwhile, in 2025, the percentage is 2.25. So at the end of the day, whether you want to go for Q1 2024 or Q4 2024, we're still seeing that disparity. We're still seeing that, something needs to be done. We need to probably work harder because 2025, you've got 92% of all of this being FPI, 5.54 being other investments, and then you have FDI at 2.25. That's for 2025. And for 2024, what we have is 61.48 FPI, 34.99 other investments, and 3.99 0.53 foreign direct investment. So that tells you that there is a lot of work that needs to be done. But away from that, I honestly, when I saw your report, I mean, I had to take, if you notice, I took everything line by line. You also talked about your GDP projection, and I honestly do not know how to react to that. But I'd like you to talk to us about how you arrived at, that projecting a growth of 4.05% for 2025. You might want to also add your best case, your base case, and maybe worst case scenario, so we can, understand where this is coming from.
Okay, so the projection of approximately 4.1% is a function of a base case, right? And that's born out of the impact of even the rebasing, right? The rebasing in itself is poised really need to show some significant growth areas in the economy. And just as we see from just the Q1 numbers, you see some interesting sectors springing out. Things like, of course, the mainstays are the likes of telecommunication, banking, which so far this year we have seen significant expansionary activities happen there. Don't forget, earlier in the year, the NCC gave the go-ahead for the increment tariff for telecommunications, and that had really much paid out up until now. That also had some impact on the equities market. We also see banking recapitalization activities. High interest rate environment has also meant good, healthy income for banks in terms of interest income. Insurance sector, a lot is also happening there. The president signed an act earlier last week that has also sponsored a lot of activities around the insurance sector. And there's also a recapitalization exercise that could also be coming in from that side. So there's really a lot of things happening in the telecommunication space and then in the banking, in the finance space as a whole. Now, then when you take it away from there, you look at things around entertainment, and be it music entertainment or movie entertainment. We've seen some level of expansionary activities around there, which we also think will have some, albeit marginal, but some impact on driving economic growth. Agricultural sector, Nigerians will continue to eat, and we think at this point, if for what you've even seen from the agri companies that are listed at the NGX, how they've performed so far this year, gives you an indication of how the agri sector is also being seen, and we think there's a lot of growth prospects coming out of there, even in this year. And then you take it away beyond that, you see transportation, a lot is happening there. Rail transportation actually is one of the fastest growing sectors in the Nigerian economy. And we think that we're still not seeing even the full reflection of what you could get from that industry. Again, we believe that we had a lot of shocks from the last 2 years as a result of subsidy removal, FX liberation. Right now, things are tapering down. Businesses are now positioning across news. We see a number of multinationals now trying to increase their stake in the Nigerian businesses. Even directors of Nigerian banks are also trying to increase their stakes in their Nigerian businesses. That's an indication of increased expansionary activities, which will drive growth. So that, I believe, is that we would see growth around the region of 4 to 4.1% for the year, and that is a base case. Of course, it also comes with its own downside risk, which involves things like volatility in the crude oil market. Right now, Brent is trading around $66 per barrel, and I know benchmark budget benchmark is somewhere around $75 per barrel, so that's a downside. But we've also seen improved production, right? The last report by the OPEC and even the NUPRC has stated our figures around 1.77 million barrels per day, and that's really good, which is even beyond what our quota is according to OPEC. That could also offset for some of the downturn we're seeing in terms of international crude oil prices. If that plays out, the chances are the economy is going to grow around that region, not without its own downside risk, of course.
All right, that's interesting. I mean, I was going to ask you the parts that must move for Nigeria to achieve the projected $1 trillion, economy target by 2030. But I think you've sort of answered that in one way or the other. So I'll add this to it. So maybe you put the parts you've not put in it. Do you think we have started well with the recapitalization of critical sectors of the economy? And, beyond that, what must follow these actions to ensure this particular goal is achieved?
Interesting question. I think the recapitalization exercise so far has been a good starting point to drive that much economic growth. So when you look at the numbers, Nigeria's GDP rebased puts it around $235 billion in nominal term, and we want to be able to achieve 1 trillion. So that means we need to grow at least times 4 in the next 5 years, and that means on a yearly basis, we need to grow at least 28% if we maintain the current exchange rate, and if we are going to see some level of appreciation in the exchange rate to about 1,002. Then we can go at the pace of 22 to 23% annually. That's a huge movement from where we are on the average of 18 to 17% annual growth for nominal, while real GDP is around 3 to 3.5% annual. So it's a huge leap, but then it is not impossible. Recapitalization is one of those things that could drive that level of growth. We also need to start moving towards an era where the interest rate movement changes into a more dovish policy. Of course, that is also dependent on what inflation plays out, which will inform the decision of the CBN. When we start seeing a more expansionary approach in terms of monetary policy, we think a lot more capital will be deployed, and that will drive economic growth. But beyond that, we need to be able to look at those are critical sectors. I don't think we are playing as much, taking advantage of, for example, the trade environment. The African Free Trade Continental Trade Agreement has been for a while now, but I don't see Nigeria really capitalizing to its fullness intra-trade with the African regions. Just not quite long, the US tariff was placed on Nigeria, and then there were a lot of conversation about how that might also impact Nigeria's trade as a whole. Of course, right here in Norrenberger, analysis shows that it won't be that significant. Of course, they only account for about 7% of our exports, and then you break that down, a huge part of that, about 93% of that export is in crude, which is not taxed, so it leaves you about 7%. And of course, many of those are also in their raw forms. So away from that conversation, the government really needs to start ensuring that private capital is easily deployed in the Nigerian economy, and that's a function of ease of doing business. So when the policies are right, when the Nigerian economy can be predicted, Nigerians can now deploy their capital towards doing business here in Nigeria. And beyond that also, we need foreign direct investment, just as we said earlier, but that's also a function of level of stability in terms of policy, political willingness to do what is right, and then more importantly, security. A huge part of the capital flight that we've had over the years has been as a result of insecurity in several regions of the country. I think if that is caught, we can start seeing some level of confidence in terms of foreign direct investment coming into Nigeria. And thankfully, we've seen the likes of Fitch and a number of Moody's and a number of ratings agencies improve our credit ratings earlier this year. That also could also play a part in driving some positive sentiment around foreign investors towards deploying capital in Nigeria. If we have a combination of this, private, foreign, and then the public does its own part in ensuring that we bridge infrastructural deficits, and then of course we can curb corruption, hopefully, and then security, we should be able to attain that desired $1 trillion. And even if we don't hit the mark, we should be close to that.
Thank you so much, Samuel Oyekanmi. I mean, it's been a fantastic conversation with you. I wish we could go on and on, but we have to end this conversation. Samuel Oyekanmi is the Research and Insights Lead at Norrenberger Financial Group. Thank you once again for your time.